All right, I think everything is all good. I can see my screen na on my end. So, hi everyone. Good evening. And of course, welcome to another Fun Smart Learning series. And of course, it's a Friday. But before we officially kick off the weekend, why not spend an hour of your Friday evening with First MetroSec for you to learn something that could actually make your Christmas and your future a lot brighter. Now, we are actually down to the last few weeks before Christmas. So it's the time of the year when we are all thinking about gifts, celebrations, and of course, showing our love to the people who love or who matter the most. But in this evening, we are actually taking a slightly different spin on the idea of giving, and we will talk about a gift that doesn't actually just last for a season, but keeps on giving year after year, and that is the gift of investing. So together with our partners from Manulife Investment Management and Trust Corporation, or MIMTC, we will explore how you can make your money work harder for you while you are still spreading that holiday cheer. But of course, before we dive in, let me just introduce to you your first Metro Securities team this evening. So I am Joana Blanca Ramos. I am a business development associate and I am based here in Mindanao. And I am glad to be your host for this session. And together with me is Miss Hazel Sabile from our digital channels and marketing team. So she will be providing some technical support all throughout our session. So maybe if you have some technical difficulties, so feel free to use our chat box. And of course, we have our guest speaker this evening from Manulife Investments, who I will be introducing in just a while. So before we proceed, allow me to mention that this presentation is for informational purposes only and does not constitute investment advice or a solicitation to buy or sell securities. Now, the opinions expressed are those of the speakers and do not necessarily reflect those of First MetroSec, which assumes no liability for any losses arising from the use of this material. And of course, to our first timers, because this webinar is actually posted sa aming mga social media channels. So we'd love for you to know First MetroSec a little better and of course understand how we can support you on your investing journey. So again, we are First MetroSec. We are the licensed stock brokerage arm of the Metro Bank Group. And at the heart of what we do are our core values, integrity, teamwork, and passion. Our vision is to become the largest and most trusted investment solutions partner in the Philippines. And our mission is to empower individuals and institutions just like you in this webinar this evening to reach your financial goals. And of course, as part of living out our company's mission and vision, the business development and market education team of First MetroSec, that is actually us, no, the ones you see sa mga webinars, we regularly conduct financial literacy sessions just like this one to help more Filipinos make informed and confident financial decisions. And of course, to further equip our clients with the right knowledge and tools, we host the Fun Smart Learning Series. Now, it is a program that brings together expert insights from our trusted fund partners. And again, in this evening, we are very happy to once again be joined by our valued partners from Manulife Investments. So over the years, we've worked closely with Manulife to deliver sessions that empower investors to make smarter choices and of course, to maximize yung potential ng kanilang Manulife investments. And in fact, MIMTC has been everywhere with us. So we've had several webinars with them. We also hosted our first ever Fun Smart Learning Series on-site event last July 2025 here in Davao City. So I actually checked our attendance, our attendees this evening, may mga clients who were actually present dun sa event na yon. And also, we even have a podcast episodes featuring them. So with the latest one now up on Spotify, so do not forget to check on it after tonight's webinar. So again, what's in it for you ba this evening? Ano yung pag-uusapan natin? We've actually got a lot of exciting and insightful topics lined up. So it is all designed to help you make this holiday season not just merry, but of course, money smart. So we will be talking about how investing can actually be a meaningful gift, not just for your loved ones, but of course, for yourself too. Now, we will also talk about why the season of giving might just be the perfect time to start growing your wealth. And lastly, we will of course explore Manulife funds that can help you achieve lasting financial freedom. So again, whether you are just planning kung ano yung gagawin ninyo for your upcoming bonuses, or maybe you are starting to set your goals for 2026, so this session is definitely for you. So again, before I introduce our speaker, can I actually hear from our attendees this evening? No, we are actually 37 na in the room. If you are excited to learn from this session, can you send some heart reaction or maybe a thumbs up sa ating chat box? Ayan. So, I hope meron tayong mga attendees who are excited to learn, no? Ayan. So, of course, allow me now to introduce our guest speaker for this evening, Mr. Paul Jeffrey Lu. So he is a chartered financial analyst and of course the head of Wealth Solutions of Manulife Investment. He is responsible for the development of new products and collaboration across the organization to identify opportunities and enhancements that will strengthen distribution potential across different channels. He is also responsible for all offshore feeder funds, including the management of cash flows and speaking for those strategies in support of distribution. So, Sir Paul, whenever you are ready.
Yes, thank you, and good evening, everyone. So, thank you for joining us today. So, again, I'm Paul Lu. I'm the head of Wealth Solutions for Manulife Investments, and I'm very excited to be here with you. So, it's November 7, and we have less than 50 days to go until Christmas. So, time's flying this year, and as the holiday season approaches, we often think about the perfect gift that we are going to give to our families, our friends, to ourselves. But today I want to talk about a different kind of gift. It's one that keeps on giving long after the holidays are over. So that gift is investing in your future. So next slide. We all have our goals, whether it's sending our kids to college, buying a home, or retiring comfortably. But let's be honest, saving alone might not be enough to reach those goals. So that's when investing comes in. It's like planting a seed today that grows into a tree tomorrow. So, what better time to start than now during the season of giving? So on the next slide, we'll look at some numbers. College tuition at a top private university can cost around 290,000 pesos per year. For a 4-year course, that would be more than 1 million pesos. And that number can even multiply if you're dreaming about sending your kids to study abroad. And a home in the Philippines, the average price for that for all housing types is about 3.4 million pesos. And if you want to live in Metro Manila, that number goes up to 4.6 million pesos. And if you really want a house instead of a condo, that number goes up further to about 7 million pesos. So these are all very big numbers. And then you have to consider inflation. So the prices of these things that we're saving for, they don't stay the same forever. Prices are expected to increase between 2 to 4% per year over the medium term. So again, while saving is important, it's investing that will help your money grow and keep up with these rising costs. So on the next slide, we want to give you a simple rule. It's called the rule of 72. So it tells us how long it takes to double your money. If your money earns 2.6% in a savings account or a deposit account, you simply take 72 divided by 2.6, and this will tell you that it will take 27.7 years for you to double your money. But look at the right chart. If your money earns something higher, like 9.7%, if you put your money in large cap US stocks, which has delivered 9.7% since 1928, if we use the same rule, and it would just take 7.4 years for you to double your money. So obviously, this is a very simple concept to grasp. The higher your return, the faster your money grows. And that's really the power of investing wisely. So on the next slide, we want to talk about compounding. So this is when your earnings start earning their own earnings. It's a bit of a tongue twister. So if you invest 15,000 pesos monthly at a 4% return, so after 5 years, you'll have 900,000 pesos saved. Plus, from your investing and compounding, you'll get an additional 94,500 pesos. So it's that chart you could see the savings that you have, that blue part of the chart is still quite large compared to what you're actually earning. But now look at it after 25 years. Your savings continue to grow. You're still saving 15,000 pesos a month. So that will grow to about 4.5 million pesos. But look at now the investing and compounding. It adds another 3.2 million pesos. That's the green part of the chart. So time is your best friend when it comes to investing. It lets your money earn and lets those earnings earn some more. So when you look at it from this perspective of saving, investing, and compounding, suddenly that college education for your kids or that home in Metro Manila, it's actually a gift that we can give our loved ones. It's becoming more affordable. So on the next slide, why talk about investing now? Because obviously the holidays are about giving. And what better gift to give yourself and your loved ones than a future of financial security? So starting now means giving your money more time to grow, and it's a gift that truly keeps on giving. Okay, on the next slide. So we'll be a bit real. Investing isn't always smooth sailing. So let's take the US stock market as an example. It has ups and downs. Since 1928, just looking at returns for each calendar year, the US stock market has gone up 73% of the time. Those are represented by the green boxes. But at the same time, it's also gone down 27% of the time. And that's represented by the blue boxes. So, but here's the key. You're not supposed to panic. So remember, we're looking at 1 year investment horizons here. Short-term dips are normal in the market. It's the long-term returns that will matter the most for investors. So on the next slide, we're showing what the same chart would look like, but now we're lengthening our holding period. So we're not holding our investments for just 1 year. We're now going to hold our investments for 1 decade or 10 years. So remember from the previous chart, if you invest for just 1 year, there was a 27% chance of losing money. There were a lot of blue boxes in the chart. Well, if you look at this chart, when we update it to a 10-year holding period, that chance drops to just 6%. There's a lot less blue boxes in this chart. And this study can be applied to other stock markets. It's not just the US stock market, it can be applied to Europe, Asia, even the Philippines. So obviously the numbers will change. You'll get different probabilities or historical probabilities of ups and down years. But the general trend and the message remains the same. Time is your ally when it comes to investing. And the longer you stay invested, the better your chances of success. Now, on the next slide, we want to show that even though it's so close to the holidays, we do understand that when we read the news, we don't always feel, that Christmas cheer. It can seem like a scary time to invest in when you read the news about wars, about politics, about trade tariffs. But here's the reality. The stock market has been able to endure past crises. There's been a lot of them over the years. So you think about recent major events like the COVID-19 pandemic or the 2008 financial crisis. Those were very severe news that we had to endure while investing in the markets. And some of the older people here, they'll remember 9/11 or the dot-com bubble. Again, very significant events in history, but the markets have survived. And most of us probably won't or weren't around during some of these earlier events, like the 1940s, there was the fall of France. But again, major events that the markets have endured. So here's the thing, markets have dropped, but they bounced back. So if you just look at the COVID-19 period, we hit a bottom in early 2020, but after enduring that 33% decline, in just 1 month, the market rebounded by 25%. And in just 1 year, it rebounded by 77%. If you go even further, for the next 5 years, the market has actually delivered a return of 20% per year. So the markets do come back. Even in tough times, markets have shown resilience. Okay, on the next slide. Uh, this just shows that we shouldn't let ourselves be scared of investing. We know markets can be unpredictable, but staying invested also means you won't miss out on the best days. So in this example, if you invested $10,000 in the US stock market way back in 2005 and you stayed invested for 20 years, you would have $71,639. And that's a fantastic growth rate. You nearly grew your money by more than 7 times. But if you miss just the 10 best days, so this is 10 days out of 20 years of investing, you would end up with less than half of that, just $32,000. What we're saying is no one can predict these best days. So staying invested is actually the smartest move. Okay, on the next slide. So even though investing can be rewarding in the long term, we understand that you can't ignore all of these risks. So one time-tested way to help lower the risk in investing is through diversification. So imagine you're preparing a Christmas gift basket. You wouldn't fill it with just one item, right? You'd probably include a mix, maybe chocolates, cookies, coffee, wine. That way, if someone doesn't like one thing, they'll still enjoy the other things in the basket. And that's similar to what diversification is when it comes to investing. Instead of putting all your money into one type of investment, you spread it across different types of investments. You create a basket or a portfolio of stocks and bonds from all over the world. And why do you do this? Because not all investments perform the same way at the same time. If one goes down, others might go up or stay quite stable. So diversification helps reduce risk and smooth out the ups and downs. So just like a well-balanced gift basket that can bring joy to everyone, a well-diversified investment portfolio helps protect your money and gives it more chances to grow over time with less risk. Okay, on the next slide. So one way to diversify is to look at investing globally. We live in a global world, so every day we use products from companies that are not in the Philippines, but are actually companies that are domiciled somewhere else in the world. So in the morning, we use our Samsung phones from Korea. We drive Toyota cars from Japan, and we drink Nestle coffee from Switzerland. In the evening, we purchase with Visa cards used. These are from the US. We fill up our cars in Shell stations. These are from Netherlands. And of course, we drink our own San Miguel beer. We still support our own products. That's from the Philippines. But investing globally helps you spread your risk so that you're not exposed to a single economy. So if something goes wrong in one country, you can rest assured that you have other holdings in different countries which may be doing much better. Plus, they also allow you to tap into large companies. So we know a lot of the global companies, the ones that you see here like Samsung, Toyota, Nestle, they can be found in other markets, but these companies operate in different parts of the world. So they can capture the different opportunities, even though they're domiciled in one country, they service globally. Okay? On the next slide, there's also another way to diversify. So the other way is to look at investing in different asset classes. So stocks aren't your only option to beat the savings deposit. There are also bonds. Bonds can give you regular interest or coupons, and they return your investment at maturity. So in this example, if you can also buy a bond at a discount, it gives you even higher returns than what you see on the coupon. So the bond selling at a 15% discount and paying a 4% coupon, over 6 years, that would actually give you a return of 46%. And that's through a combination of regular income and price gains. So it's a very different investment type compared to stocks. Stocks, we know there's no requirement for these companies to regularly pay their dividends. There's no requirement for them to return the principal at maturity date. But this is exactly what we want when we're talking about diversification. We avoid adding investments that is more of the same, but we add differentiated investments, unique investments, so that diversification can really shine. Okay, on to the next slide. So this shows what diversification could look like over the past 10 years. So first, we want to point out that there was no investment that was consistently the best performing investment. So for 1 year, it was US stocks. They were the best performers. The next year, it could have been international stocks or international bonds. That's why diversification is key. It helps protect your money from the ups and downs of any single investment. So can you imagine if you were invested in just one single asset class and that happened to be, one of the worst performing asset classes? You would get scared of your investments. And that's why it's so important. Diversification helps ensure that you don't own too many of the worst performing asset classes. And that helps you stick to your financial plans. So if you just focus on the yellow box in this chart, that actually shows you what a diversified portfolio looks like. The returns aren't always going to be at the top. They're always going to be middle to above average, but it was able to deliver returns that still meet your financial goals. There are calendar years here where you're still seeing double-digit returns, but you're also seeing much less volatility. Suddenly, your investment journey doesn't become so scary anymore. It becomes more of a smooth journey, and that helps you stick to your financial plan. Okay, on to the next slide. So we just talked about diversification, spreading your investments so you're not putting all your eggs in one basket. Now, how do you actually do that? And this is where our UITFs can help. Through FundSmart, we make diversification easy and accessible. So instead of buying individual stocks or individual bonds yourself, you can invest in professionally managed funds that already spread your money across different assets, different regions, different sectors. So for example, if you are an investor that wants growth, you want your capital to become much bigger and beat inflation, we have global equity funds and they can invest across the world. So this can be from developed markets like the US or Europe to emerging markets like China and India. So when you read the news about artificial intelligence, the technology sector, it's so exciting, but it's in the US. Global equity funds can actually invest in the US. There's nothing stopping them from getting a piece of that pie. At the same time, if you read the news earlier this year about DeepSeek in China, and suddenly China has artificial intelligence as well, global equity funds are flexible enough to allocate some of your funds into China so you can also capture that growth. Now, there are also different solutions that we offer. So aside from the broad global equity funds, you can see we have sector or thematic funds, and we also have regional funds. So you can take that global equity fund and you can tweak it to your liking. If you're somebody who really believes in the technology sector or the healthcare sector, you can allocate a bit of your money to those sectors as well. And if you have, let's say, a preference for China or India, these emerging markets, and you want to have a bigger allocation to that, you can also sell some of your global equity funds and just allocate it towards these regions. You can mix and match these global equity funds to your liking to suit your needs. Now, if you want something different, you're not looking for capital growth, but you're looking for income, we also have global multi-asset solutions for you. They can invest in stocks, bonds, and even alternative asset classes like REITs or preferred securities. So that's really the beauty of a multi-asset strategy. It's a one-stop shop for instant diversification. So you leave it to the fund manager to choose which asset class you should be investing in. And because it's a global fund, it also has that flexibility to choose which country or which region or which sector you should be investing in. And it will be keeping it all diversified so you don't have to do the thinking. If you want something safer, we also offer low volatility strategies. And these are things that you can tweak again based on your needs. The one core low volatility strategy that we have are obviously your money market funds. They're very safe investments. They are very competitive against deposits, but they give you that liquidity. So whenever you need money, it's very easy to sell money market funds to fund your expenses. So these are just some of the offerings that we have. We have about 22 funds in total, but we're looking to continuously add more whenever we see good investment opportunities for the clients. And obviously, you have to think of these UITFs as ready-made, gift baskets for your financial future. Each one is carefully curated by fund managers, experts. They give you already a mix of investments that match your goals and risk appetite. And the best part is you don't need a huge amount to start investing in these funds. It's just a small initial investment, typically 100 pesos or 1,000 pesos. You can already invest in these funds and you can access global markets, diversify your portfolio, and start building your wealth today. So again, this holiday season, instead of just giving gifts that last a moment, why not give yourself and your loved ones the gift that keeps on giving? A diversified investment portfolio through FundSmart is something that can help you achieve your financial goals. So with that, I'll pause here and I'll turn it back over to Joanne for the next portion of the presentation.
All right. Okay, I think everything is so good. Again, Sir Paul, thank you for that very insightful, of course, practical as well, and very concise na discussion. So I believe our attendees this evening were able to pick up great takeaways, starting from the rule you shared, the rule of 72, as well as showing our attendees here tonight all the funds available. That is actually, you can see naman sa FundSmart. And of course, yung things I mentioned kanina, from seeing actually how investing can be a meaningful gift to also realizing that the holidays are actually perfect time to start growing our wealth. And of course, how Manulife funds can help us build a brighter financial future. Now, as always, to our attendees this evening, we will be having a live Q&A in just a bit. And if you remember, we actually ask you to submit some advanced questions. So we will be prioritizing them later. And if time permits, we will also check our live Q&A for the questions. So again, feel free to send them sa ating Q&A panel. So let's just give Sir Paul muna a short breather. And then while he is doing that, let me quickly share to you how you can access Manulife UITFs right here on FundSmart. So again, here at First Metro Sec, your convenience is always our priority. So that's why we've made an investing, or we have actually made investing simple with our multi-asset investment platform. So everything you need all in one place. Whether you want to invest in stocks, ETF, bonds, REITs, and of course funds, you can invest in all of them using just one account. So basically, there's no need to remember different username or password, and at the same time, there's no need to switch between different brokers. With First MetroSec, you've got an all-in-one platform that makes investing easy, efficient, and of course, perfectly aligned with your financial goals. So, how do you add Manulife investment funds to your portfolio? That is actually the question I believe some of you here wanted to ask. So again, it's super easy. Just log into your First MetroSec account and then head over to the FundSmart dashboard. So from there, you'll have to access or you have access to Manulife Investments wide selection of UITFs. So simply apply the filter and choose Manulife Investment from the drop-down list. And then just click on any of the fund you'd like to explore. And then after that, you will be taken to the research tab. That is where you can learn more about its fund profile, features, performance, and of course, how it fits your goals. Now, in this evening, we will be featuring one of the funds now from Manulife. It is under the income fund, if you've seen kanina sa mga list of funds ni Manulife. So this one is Manulife Global Multi-Asset Diversified Income Feeder Fund. So again, when you visit the research tab, you'll find the fund profile, which actually includes key details like the risk rating. So this is a 3. The fund code, also quick access to its website, KIDS, and DOT or the Declaration of Trust. Again, this information, you need this to understand the fund better. Now, again, what makes this fund interesting is that this is an income-paying fund. So it aims to provide regular income to investors through dividends or interest. It is especially suitable for those who are looking for a steady cash flow from their investments and, of course, also still getting exposure to a diversified global portfolio. Now, if you scroll down, you'll see the fund overview that includes the asset type, its investment objective, and also the currency. You will also see the fee information. So from here, you can check that you only need 1,000 pesos to invest in this fund. There's also no minimum holding period for this fund. Next, you will see the performance. So again, compare the performance of the fund based on year to date, 3 years or 5 years or so. So what's good about FundSmart is you can actually start investing for as low as 1,000 and also there's no sales load or transaction fees. And if you scroll further down, you'll see the NAV chart. So compare the prices 1 year to date, 3 years or 5 years. You can also see the top holdings and the fund allocation. And of course, for your convenience, you can actually scroll the fund right away from this dashboard. So all in just a few clicks lang. And of course, since this webinar is open to the public, and for those of you joining us today who don't have a First MetroSec account yet and would like to start investing in Manulife investment funds, getting started is actually fast, convenient, and completely seamless. So all you need to do is to download the First MetroSec Go app and register directly from there. The requirements are actually simple. You just need proof of identification, proof of billing address, proof of your settlement bank account, and then a sheet with 3 specimen signatures, plus an initial deposit of 1,000 pesos, which is fully investable once your account is activated. So if ever nag-reflect na siya under your cash, you can actually invest in any of the Manulife funds. And of course, here is a quick tip. Do not forget to enter the event code GIFT during the registration because you will be asked, how did you learn about us? So in that way, we will know that you came from this webinar and also you found value in today's discussion. So again, stay connected with us even after today's webinar. Just look for our official handle at First MetroSec on your favorite social media platforms. This is where we regularly share market updates, announcements, and of course, webinars to help you along with your investing journey. And also, you can check out our Spotify channel for some audio learning on the go. So if you want to listen to the podcast episode with MIMTC, so you can actually listen to it during your commute or maybe downtime lang. And of course, if you miss any of our past webinars, no worries. just visit our official YouTube channel. That is where you can actually replay all our sessions now at your own pace. All right, and of course, we've got more free webinars coming your way. They are all designed to help you build your knowledge and confidence in investing. So to register, just check the chat box because Miss Hazel will be sharing the link to our calendar of events. So feel free to sign up for as many sessions as you like. Again, these webinars are completely free. And of course, if you want to invite First MetroSec, maybe schedule a free customized financial and investment literacy sessions for your company, for your individuals, or even for your family, feel free to send us an email at marketeducation@firstmetrosec.com.ph. All right. Again, so we've now reached our Q&A session. So just like what I mentioned kanina, during the registration, we ask you to submit your questions. So we will be prioritizing them. So later I will be sharing, no? Without any further ado, let's welcome back our guest speaker, Sir Paul, to help us answer your questions. So again, let's kick things off with our first question that is this one. Okay. So I hope no the attendee or the person who requested the question is in the webinar, no. First question, what are the considerations for a post-retirement financial management? Any practical tips for stocks and bonds, UITF, etc.? Sir Paul?
Okay, thank you for that question. So first of all, I want to say that every person will probably have their own unique situation. But I guess for a typical retired person, I can provide a few practical tips, which I think should apply generally. First, for the retirees, capital preservation becomes more of a priority than growing your capital. So after you retire, your priority will start to shift from aggressively growing your money to thinking more about protecting your wealth, just preserving your capital. So UITFs can help because they offer professionally managed funds with different risk levels. So a retiree can, take a look at multi-asset funds and bond funds to help reduce their risk. So if you were an investor that was typically invested in equities, especially single stock companies where there's so much risk and volatility, you might want to look at, starting to shift some of your allocation towards funds which are more diversified and consider asset classes like multi-asset or bonds, which have, much safer risk profiles. And second, I guess another important consideration for retirees is that there's a need now to start supplementing your income. So when you were employed and you were not yet retired, you're used to living with, getting salary. You get money or cash inflow every month. You get bonuses every, year. You need to supplement that. And part of that is done through our pension system, but you also need other income sources. So this is the beauty of our UITFs. We also have funds that give monthly income. They pay out every month, and that can make it easier to manage your day-to-day expenses when you're retired. Because obviously, we're very used to living in such a way that we get income every month if you're a salaried person. If you take that out, the UITFs with an income payout can actually make it more seamless as you transition to your retirement years. And obviously, last tip, don't forget our earlier slides on diversification. It's a time-tested way of reducing risk and still meeting your financial goals, which in this case would be more on capital preservation. So even in our funds, don't put all your eggs in like one income solution or one equity fund. Consider a mix of our funds that's more on the safer side. Consider allocating towards income funds to get some sources of income that you can use for your day-to-day expenses, and obviously continue to diversify.
All right. Thank you, Sir Paul, for that very practical answer. Okay, on to the next question. I will take this one. I have an account at FMSBC. Do I need to fund my account at FundSmart? So actually, for this question, if the answer is yes, you'll need to fund your first MetroSec account. But just like what I mentioned, no, our platform is multi-asset. So once you have a fund, the same fund can actually be used for stocks, mutual funds, and even bonds. So, which means you only need one account to invest in different asset types. There's no need to open separate accounts for each. So if you already have cleared cash in your portfolio, you can instantly use it to subscribe to funds, and that same cash can also be used to buy stocks, invest in bonds, and of course, for funds all in one place. So as long as your cash is cleared, you are ready to invest in any of these asset classes. Okay, so for the next question, this is for Sir Paul. Any tips for a 30-year-old still establishing entrepreneur when it comes to making investment decisions?
Okay, so yeah, this is a bit of a different situation compared to the first one. This person is obviously in a different stage in his life. Again, every person will be unique, and I'm going to generalize here. But for a young entrepreneur, you can obviously consider our growth-oriented UITFs. So if you go back to the list of funds that we have a slide there. You can see we had a list of funds, mostly equity funds, which are for capital growth. And really, at age 30, the biggest advantage that you have is time. You can take on more risk because you have decades to recover if there's some market fluctuations that happen in the short term. And so UITFs focused on equities makes sense. But even if you're aggressive, don't put everything in one basket. As I mentioned earlier, you can always mix our more diversified global equity funds with some of your, regional funds that you like or your sector funds that you like. So the global equity fund will give you that very broad exposure to just equities in general. But if you think highly of, let's say, an emerging market like China or India, these are faster growing economies compared to the rest of the world, especially India, which has a very strong domestic economy. If you feel strongly about that, you can take some of your allocation in the global equity fund and shift it there. And it's the same story if you look at our sector or thematic funds. So we have two right now, technology and healthcare. Obviously, technology is very popular right now because of the boom in artificial intelligence. We think there's a long runway when it comes to really the digitalization of the economies. You can see ChatGPT. I think the adoption rate for ChatGPT when it launched, so the number of users who registers reached 1 million in just 5 days. And if you compare it to other technologies like Facebook, Twitter, which is now called X, those took 1 to 2 years to get 1 million users. So you can see how fast artificial intelligence is suddenly now part of our, day-to-day life. So if you feel strongly about the technology sector and it's a faster growing part of the global equity sphere, consider allocating to that as well. You have time and you can take risk. Now, one other thing I want to point out is you also mentioned you're an entrepreneur. So you might also want to consider liquidity for your business needs. Being an entrepreneur and running a business, you don't get that salary, you don't get that steady stream of income. Sometimes it's very high, sometimes profits can be a bit low. So entrepreneurs often need quick access to cash for, opportunities or emergencies. So you can also keep some of your funds in our money market UITFs. They're actually great ways to still earn money from your savings, but at the same time, if you have short-term needs, it's very easy to pull out. And these are, very safe investments. So you don't have to worry that you're pulling out at the wrong time. So again, keep some money in money market UITFs, but I think you can allocate more towards global equities because you have a riskier, risk appetite. And so you can have your growth investments work in the background for you.
Yes. Thank you, Sir Paul, for that very good answer. No, it's a very good tip for our soon to be entrepreneurs as well. So for the next question, I will take this one. In case of death, disability, or other life-changing events, how can I or an authorized person consume the fund without major losses? Now, this is actually a great question, and thank you for asking that. To give you a more detailed answer, I'd like to invite everyone to our upcoming webinar on November 18 entitled Rest in Peace Handling Investments After Death. So in this session, we will actually discuss how to properly handle the account of a deceased investor. It is a very important topic that many of us actually doesn't or di natin masyadong pinag-uusapan, but actually we really should. So after all, kasi one of the many reasons why we invest is to secure the future of our loved ones. So knowing the right process and the guidelines can actually make a big difference for the families we leave behind. So again, if you want to join, just check our chat box and check the calendar of events. It will be on November 18, hosted, I think, by Miss Monette. Okay? So for this question, all right, this is for Sir Paul. How has the unstable international conditions and currency volatility reshaped your fund allocations strategies?
Okay, thank you for that question. Again, yes, there is a lot of uncertainty in the world today. You open the news, you see all of these, negative news on wars, trade tariffs, trade tensions, and that really reminds us of, that one key principle that we've been talking about today, which is diversification really matters now more than ever. So again, from my earlier slides, we saw that markets are quite unpredictable. It's a different asset class which will perform well each year. It's hard to say which one it's going to be. And if everyone had a crystal ball, we'd all be rich. But one way to really get around that is through diversification. So these tariffs that we're reading about, they can impact, specific sectors or specific countries much more than others. So obviously concentrating your investments in just one economy or one industry really increases the risk, and that's what we're talking about when we, talk about diversification. You don't really want to be concentrated in the worst performing asset classes. That could have some long-term repercussions on your financial plan. So our approach with UITFs is to broaden the global diversification. Instead of focusing heavily on just one country, we allocate across global equity funds. You can even see it in our, flagship global equity fund. We used to be very concentrated in the US, but since the tariffs started, they've actually taken out some of the money from the US stock market and they've started to reallocate to countries or economies where there's less of an impact. You saw them start to go into Europe, start to go into Japan. They took a look at China. So you're seeing them diversify even within the funds. And obviously, you can do that further to our other funds. So if you want to consider other regional funds, you have funds that are focused in ASEAN or India, which are more domestic focused economies. And you also have those sector funds like technology and healthcare, which have structural growth stories where you see the tariffs impacting it a bit less. So this helps cushion the impact of tariffs on any single economy. We would also aim for a more balanced exposure. So we recommend looking at, different asset classes. So if you look at our multi-asset fund, you can see it's very balanced right now, about 50% in equities, 50% in fixed income. We don't want to over concentrate in one asset class, even within the funds that we manage, because we're cognizant of the fact that it's a very uncertain environment today. And that really helps reduce the volatility of our funds, especially with our income solutions. They pay out monthly dividends. So that's another thing that you want to consider. You may want to shift some allocation or take a closer look at our income funds, because that monthly payout that you receive from them, it helps cushion the impact of that day-to-day volatility that you might have in today's environment. So again, UITFs make this easy because they're professionally managed and they're already diversified across multiple assets and geographies.
Right. Thank you, Sir Paul. I actually checked our Q&A panel. We have this one question actually related din siya, no? From an anonymous attendee, with the US stock market reaching all-time highs, do you think it's still advisable to enter during this time? So I think it was answered, but maybe you can share some additional inputs.
Yeah, I can share some thoughts on the US stock market. Obviously, we have one fund of ours, one of our regional equity funds is focused on the US and it's done very well. Again, it's at all-time highs. When you look at the US stock market today, if you just look at, the top 10 companies, most of them actually the Magnificent Seven. It's like these seven companies where all of the money is actually flowing into, and that's really what's driving it to reach these all-time highs. So these used to be about 20% of the US stock market. Now it's accounting for about 40% of the US stock market. So if you buy like an ETF that's exposed to the US, you're actually not that diversified. You put $1 into a US ETF, 40 cents of that goes to just 10 companies. So you're actually very concentrated when you're investing passively in the US stock market. But the good thing with our funds is, again, they're professionally managed. You have the fund managers realizing that there's a lot of concentration in these large cap companies. And what we've actually done is we've moved some of the money away from these expensive large cap companies. And we see a lot of good opportunities in mid cap companies. Mid-cap companies are basically those that are not as popular as like your Nvidias, your Googles, your Amazons, but they benefit from the same trends when it comes to like technology and artificial intelligence. So they're valued much cheaper, but their earnings growth, their revenue growth could be just as fast, if not faster, compared to these large companies. So if you look at the US as a whole, yes, it does look expensive and it's at all-time highs, but it's such a deep market that there are still plenty of opportunities to play with within that market.
All right. Thank you, Sir Paul, for that additional insight. Now, on to the next question. I'll take this one. Are there discussions on investing in PSE? Now, this is actually a question, no? I think for beginners, ito siya. So we actually have a session designed exactly for you. So our Stock Market 101 webinar. In this webinar, we break down the basics of investing and explain how stock market really works. Once you are familiar with the basic, you can actually or also join our basic education on stock trading. This is what we call BEST. It is a three-part session. Now, in this session, you will actually learn how to start trading confidently and strategically. And of course, if you want to explore more, we have webinars focused on specific companies and sectors as well. So you can catch all of this on our YouTube channel, and if ever, you can check our social media pages if we have an upcoming webinars related to these sessions. Now, I think this is our last question for Sir Paul. What fund gives monthly dividends?
Yeah, so we have 22 funds, and out of that, we have six that are what we consider income solutions. So they pay out periodically. But out of those six funds, we only have five funds which pay out monthly income. So the flagship would be our Global Multi-Asset Diversified Income Feeder Fund. We call it GMADI for short because it's such a long, fund name. But basically, GMADI is a go anywhere type of strategy. You let the fund manager look for income from all over the world, from different asset classes, both traditional and non-traditional asset classes. And it's going to try to deliver a distribution yield of somewhere close to about 5 to 6% historically. So it's something that's, very, I guess, passive when it comes to investing because you let the fund manager basically decide where he's going to source that income. Now, we also have other income paying funds that do it on a monthly basis. So we have what we call alternative income because, these are not your typical stocks or bonds. They're REITs and they're preferred securities. So REITs, I think it's a bit more popular now in the Philippines, but at the time that we launched it, I think there's only one or two listed REITs in the Philippines at that time. So obviously the education on REITs has improved a lot, but it's the same concept. These are property companies who are earning rental income, and from that rental income, they pay monthly. So we collect that income and then we pay it out to investors. And it's a great way to earn income, but at the same time, you can also benefit from some price appreciation because we're still invested in equities. So there's that inflation protection angle to it. And then you have global preferred income, which is kind of like your preferred shares. But obviously, because we're in a global market, there's a lot more depth in the market. We can look at subordinated debt, preferred stocks, perpetual capital securities. There's a lot of different asset classes that we can play. But the good thing here is that these are investment grade companies. They're very high quality companies. And the way that preferred securities works is that it has the benefits of what people usually like from bonds. There's this regular payment. There's usually a maturity date. And if it's not a maturity date, it's a call option date where you can get your principal back. So it's kind of like fixed income, but it gives you a higher yield. But at the same time, it's very high quality companies that are, that we're investing in. And the last two funds that we have are obviously Global Income and Asia Dynamic Bond. These are global bond funds and Asia bond funds. And obviously, if you're talking about income, you're always going to have this asset class as a consideration.
All right. Thank you, Sir Paul, for telling our attendees no those funds that gives out dividends. And I think we still have time. And I believe ito na din yung last question that I'm seeing from our chat box. Any recommendation for a novice who wish to start investing in the US stocks?
Yeah, I guess if you're a first-time investor, you have to understand that there's going to be a bit of risk, especially if you're jumping straight into the US stock market. Um, if you, I mean, I would consider, obviously diversification, and you can get that through a fund. If you invest in one of our UITFs that's focused on the US equity market, you do get the benefits of a fund manager choosing the companies for you. So you don't have to do your due diligence on several companies. You can let the fund manager and that fund manager's research team do it for you. Because obviously you're jumping in at a time where there's a lot of uncertainty in the world. And again, with this uncertainty, we really want to harp on diversifying. So if you jump into investing in individual stocks in the US, it could be a bit risky, especially with all of the tariff concerns that we're dealing with. So we're hoping that you would diversify your investments and you can really use our funds to be able to do that.
All right. Thank you, sir, for answering the question. So I think, all right. So that's all the questions we have for now, no? But before we officially wrap up, we'd love to hear your thoughts and, of course, no, any suggestions you would like because your feedback actually really matters to us. So it helps us make our webinar even better and, of course, let us know what topics you'd like to see next. So just scan the QR code on your screen to access the quick feedback form. So it will only take a few minutes, no? And then while you are filling out the form, and of course, before we officially close, I'd like to turn again the virtual floor back to our guest speaker, Sir Paul, to share some few final thoughts or advice to our attendees.
Yeah, just some final words from me. I think based on some of the questions that we're receiving, we can tell that investing can be quite emotional. It's normal to feel excited when the markets are rallying, but at the same time to get a bit scared when they're going down. But the thing is, emotions, they can lead us to make some poor investment decisions. We'll sell low, we'll buy high. And that's where I think we come in, people from First Metro, people from Manulife. We're here to help you stay focused and disciplined when it comes to investing. It's actually something that we see historically. When markets peak, we're seeing investors rush in, and when they drop, we're seeing them sell. And this behavior really leads to, buying high and selling low. And we want to help you avoid these traps, and we want to help you stay invested for the long term. I mean, just going back to the earlier slides, it's really staying invested, which will make a difference for your financial goals. So we're here to help. Your financial professionals, they've seen tough markets before. They can help you build a plan and stick to it. They know when to adjust the strategy. And most importantly, they can help protect you from making some very emotional decisions, which can lead to your financial plans being put at risk. So let me leave you with a quote from Warren Buffett. Obviously, he's a very popular investor. We don't have to be smarter than the rest. We have to be more disciplined than the rest. So really, this holiday season, consider giving yourself and your loved ones the gift of a better financial future. Start investing today, and you just let your money work for you.
All right. Thank you, Sir Paul, for that advice. And again, thank you so much, everyone, for joining this webinar. And of course, no, we thank you to Sir Paul for maximizing the Q&A session. So we were able to answer a few questions actually. And to our attendees, thank you for staying until the end of this webinar. We hope you really found the session insightful and of course valuable in helping you make smarter investment decisions. Again, your questions really made the discussion even more engaging and meaningful. So to everyone here, stay tuned for more learning opportunities from First MetroSec. And remember, we are always here to guide and support you on your investing journey, just like what Sir Paul mentioned. So once again, everyone, on behalf of First MetroSec, this has been Joanna, Hazel, and Sir Paul, wishing you a wonderful evening and of course, and as always, happy investing. Thank you, Sir Paul. Thank you, everyone.
Thank you, everyone.